Welcome to the deep dive. Today we are dissecting a company that is, well, the perfect, bizarre embodiment of this late 2025 bull market. On one side, you have technology that's so revolutionary it could genuinely redefine global supply chains. But on the other, you've got a financial statement that is just screaming imminent collapse.
We are talking about SMX, Security Matters Public Limited Company, ticker SMX. And this case is urgent. Just last Friday, November 28th, 2025, the stock had what you can only describe as a short-term explosion. It surged 78.16% intraday. That pushed the share price up to a dizzying $31. An astonishing technical move.
And here's the paradox we need to solve for you. How can a company with that kind of explosive momentum simultaneously have an auditor-issued going concern warning? I mean, the auditors themselves are saying they doubt the company will even survive the next 12 months. And on top of that, it's lost a staggering $44 million over the last year.
It's the ultimate cognitive dissonance for an investor, right? Our mission today isn't just to summarize the story. It's to apply the most rigorous defensive framework we can, the Graham-and-Dodd, the Buffett value investing principles. To really dissect this deep tech microcap, we have to cut through all the promotional noise and figure out what the true intrinsic value is here.
And we can actually give you the conclusion we'll be building toward right now. While the underlying technology, this barcode for molecules, it holds immense transformative option value for the future, no question. But the equity, the stock, currently trading at $31, offers zero, absolutely no margin of safety.
Right.
Our detailed analysis suggests this price is just a temporary liquidity spectacle. It's trading at a premium we estimate is over 520% above any conservative liquidation value.
And that specific price surge, it's just so disconnected from financial reality. It's a textbook example of a speculative episode. It's fueled entirely by narrative and market mechanics, not fundamentals. So to understand why, we have to start at the very beginning with the business itself.
Okay, let's unpack this. We have a potentially world-changing technology, but it's trapped inside this heavily promotional management team, which is presiding over a balance sheet that's effectively on life support. We have to figure out if this is even a good business first.
Agreed. Value investing always starts with the business quality. If the business is fundamentally flawed, then the price just doesn't matter.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding. Let's start with the basics. What does SMX actually do? And, more importantly, does its technology offer that sustainable competitive advantage? That wide, durable economic moat that separates the companies that last from the ones that are just flashes in the pan. Their whole technology aims to solve what the industry calls the Oracle problem.
The Oracle problem is, well, it's maybe the most fundamental challenge facing global commerce right now. It's this crucial disconnect between physical reality and digital verification. Think about any supply chain today. We rely almost exclusively on digital or paper trails, invoices, customs forms, ESG certificates to verify where a product came from.
And those systems are just remarkably easy to forge. If you're a jewelry company, a paper certificate tells you your gold is conflict-free. If you're a plastics manufacturer, a piece of paper says your pellets are 100% post-consumer recycled material. But how do you actually prove that in the real world?
That's the problem.
Yeah.
And, we've seen the rise of blockchain technology, which is fantastic for creating an immutable digital ledger. But if you feed that secure, immutable digital ledger false information at the beginning, the classic garbage in, then the perfect record you get back is still worthless. Garbage out. Yeah. The whole system fails because the digital truth is just completely disconnected from the physical reality.
So that brings us to SMX's solution. Submolecular marking. This is where the deep tech vision really begins.
Right. This technology is built on core IP that was derived from Israeli government research. SMX has developed a chemical marker, it's like a synthetic DNA of sorts, that is physically embedded into raw materials right at the manufacturing stage. And crucially, this isn't a label, it's not a sticker on a package. It is incorporated into the material itself, solid, liquid, or gas.
And the key feature here, the thing that gives it the potential for that durable moat, is immutability and resilience. I mean, traditional methods, barcodes, QR codes, even some other markers, they're destroyed the moment the product is processed or recycled.
Exactly. SMX markers are chemically designed to survive these extreme industrial processes. Take plastic, for example. An SMX-marked plastic bottle can be shredded, melted at high heat, turned into raw pellets, and then remolded into something completely different, a plastic chair, a car part. And that molecular marker, it persists through that entire chemical and thermal cycle. It's readable at every single stage.
That makes it revolutionary for the circular economy, which is totally dependent on verifying the history of the recycled material, not just the package it came in. But how does it work without, changing the material itself?
So the marker is designed to be invisible to the naked eye, and it's chemically inert. It doesn't change the physical properties of the host material. No change in color, strength, flexibility, nothing. Detection requires a proprietary piece of hardware, a specialized reader. It can be handheld or an industrial sensor on the line. It excites the marker using specific spectral frequencies, and the marker responds with a unique proprietary signature.
And that signature is the physical link to the digital world. The reader captures it, feeds it into an algorithm, which then identifies the location, the time, the specific batch, and logs it onto a blockchain ledger. It's basically a seamless barcode for molecules.
And this level of technical control leads right to their strategic goal. They're not just selling a chemical product, they're trying to sell a regulatory standard. They've branded their whole system as the molecular proof network, and their aim is to create massive switching costs and network effects.
The toll bridge model, right. If they can get enough key players, refineries, manufacturers, regulators to mandate their markers and readers, they basically become the only game in town. They just collect a royalty, a toll, every time the material gets scanned.
Precisely. And the sources show that their 2025 partnerships are laser-focused on building this toll bridge strategy at major industrial choke points all over the world. These 6 partnerships of 2025 really demonstrate this vertical integration strategy perfectly.
Let's focus on the 2 biggest ones because they really show the scope of their ambition. First, precious metals. True Gold and the Dubai Multi-Commodities Center, the DMCC.
This is SMX's attempt to clean up the, let's be honest, the notoriously opaque gold supply chain. The DMCC is one of the world's largest and most influential free zones for commodities, especially gold. If SMX can successfully convince the DMCC to mandate their physics-based marker as the required standard for all gold traded through that hub, the geopolitical implications are staggering.
They'd be creating a de facto monopoly in that critical segment, instantly. Their verified gold would get a market advantage, probably a premium price, and it solves a massive regulatory problem for Dubai, which has faced a ton of international pressure about sanctions evasion and conflict gold.
Yeah, but the hurdle is implementation. It's one thing to run a pilot project. It's a whole other thing to embed readers and marking processes into every single refinery involved in a massive global hub like Dubai. But the prize becoming the mandated standard, it's huge.
Okay, second, the circular economy push. Their plastics collaboration with TradePro Inc., a major U.S. recycling company.
This directly addresses the new EU Digital Product Passport and the U.S. Extended Producer Responsibility laws. TradePro processes huge volumes of plastic resin. By embedding the SMX marker, TradePro can then sell that resin at a substantial green premium. They can call it verified recycled resin because its history is provable at the molecular level, surviving that whole recycling chain. And SMX then shares in that premium. The success of this collaboration is directly tied to the future revenue of the entire company.
And we also see these other targeted partnerships, industrial rubber with Continental, and identity play with Fingo, linking biometrics to material handlers. It's a multi-front war they're fighting. But as you said, no moat is built in a vacuum.
Right. We have to look at the competitive landscape. This market is not empty. The SMX moat is under constant threat from established players.
Okay, let's dive into the competition. First up, Digimark, or DMRC.
So DMRC tracks the packaging using digital watermarking embedded in the artwork. They're the established powerhouse in traceability. They're dominant at the retail level, at the point of sale. They're mature, financially robust, and have huge market share. Their whole strategy is about brand protection and efficient checkout.
So Digimark has the strong financials, the wide adoption, but their weakness is the post-consumer phase. Their marker is gone the second you toss the package.
Exactly. Next, you've got Applied DNA Sciences, or APDN. They are a much more direct competitor to SMX. They use biological DNA-based markers, and they have strong penetration in high-value, high-risk areas like textiles and pharmaceuticals.
What's the crucial difference there? A chemical marker like SMX's versus a biological one from APDN?
It comes down to stability and industrial scalability. Biological markers based on DNA strands can be susceptible to the really harsh thermal or chemical processes in large-scale industrial recycling. Think high-temperature melting or the aggressive chemical solvents used to treat plastics or rubber. SMX claims its inorganic chemical marker has superior resilience in those specific environments.
And finally, there's Oratane, which takes a completely passive approach.
Right. Orotane uses isotopic analysis. They test the natural chemical fingerprint of the material itself, like the soil where the cotton grew,
Yeah.
or the feed given to the livestock. The advantage is cost. You don't have to add a marker. The disadvantage is granularity. You get provenance where it came from, but you don't get real-time, high-speed, verifiable tracking through the whole life cycle, especially after it's been recycled.
So the synthesis is pretty clear. SMX is staking its entire future on the one niche where its marker is uniquely durable. That's the circular economy, where you have to track materials through these destructive high-heat processes. The moat is very, very specific.
And that potential moat is what creates the option value. But now we have to shift from the tech itself to the people running the show. If the financials are terrifying, we have to ask, are the leaders ethical, effective stewards of shareholder capital?
Chapter 2, Management Evaluation. When we apply that stringent Buffett test, we look for three things in management: intelligence, energy, and, most critically, integrity and capital allocation. The visionary here is Haggai Alon, the founder and CEO.
And Alon certainly scores high on intelligence and energy. I mean, he conceptualized this whole economy of proof and has driven the company to attract these significant industrial partnerships. Plus, he still has a substantial equity stake, around 17.7%, which, theoretically aligns his success with the company's. That's his skin in the game. His official compensation, around $281,901, it's also pretty moderate, which suggests he isn't excessively looting the company while it's burning cash.
So he believes in the vision, he's not raiding the treasury. Where does the integrity and capital allocation part fail? Because, as our sources show, this company has been a dilution machine.
This is the critical failure point, and it speaks directly to integrity towards the existing shareholders. Management has consistently treated the public market as their own personal emergency ATM. They funded these massive operating losses exclusively through highly destructive, dilutive equity financing.
We need to spend some time on the sheer scale of this destruction, particularly the history of reverse splits just in 2025. It creates a kind of psychological trap for retail investors.
Oh, absolutely. The frequency and the size of the splits are just astounding. And they were all done for one primary reason: to artificially boost the nominal share price to stay on the Nasdaq. Look at the timeline. A 1-for-7 split in August, a 1-for-10.899 split in October, and then right before the big surge, a 1-for-8 consolidation in mid-November.
Let's be really explicit about what that does to an investor who might have bought in at the start of 2025.
Okay, so if you bought 1,000 shares at the beginning of the year, after those successive splits, your share count is just reduced to a tiny fractional amount. The total destruction of the share count means that even though the stock is trading at $31 today, the true split-adjusted price relative to its historical highs is down over 99%. This is what we call the price illusion. Investors see the $31 price tag, and they feel good, but their actual ownership percentage of the company, their equity value, has been annihilated by the sheer volume of new, cheaper shares they keep issuing.
That pattern really suggests a management team that's prioritizing just staying on the Nasdaq, which is essential for their access to capital over protecting existing shareholder value.
It raises serious questions. Do they view the stock primarily as a vehicle for financing their operations rather than as a representation of sustainable business value? It's a huge concern.
And let's also talk about management's communication style, the promotional tone. Value investors are, inherently skeptical of excessive buzzwords.
And their press releases are just dense with this stuff. Global supply chain reset, proving inevitability, market disruption. This is not the sober, understated tone of a mature, cash-generating business. It's the language of promotion, designed to capture attention.
And the timing of their strategy is highly suggestive. Their really aggressive pivot toward the plastic cycle token, PCT, and explicitly aligning with crypto regulations like the Genius Act. That perfectly targets the Reddit crowd, the retail speculative momentum traders who are drawn to these high-risk, high-narrative stocks.
It's a masterful tactical move to attract that segment of the market, which is prone to sudden, violent buying, as we just saw last week. They're effectively weaponizing the narrative to bypass the fundamental scrutiny that their balance sheet deserves. And they also file an unusual number of 6K reports, even for pretty minor developments. It's a classic microcap tactic to maintain high visibility and trading volume.
Then we have the governance structure issue, which reduces transparency even more for a U.S. investor.
This is crucial for you to understand. SMX is domiciled in Ireland, which makes it a foreign private issuer, FPI, listed on Nasdaq. This status gives them wide exemptions from a lot of standard U.S. corporate governance and reporting rules.
What are the practical implications of that FPI status for someone trying to do their due diligence?
Primarily, they are exempt from filing quarterly 10Qs. They only file these less frequent, less standardized 6K reports. So if you're a U.S. shareholder, you lose that crucial, continuous, granular visibility into the quarterly financial changes that a 10Q provides. It makes tracking their cash burn or subtle shifts in expenses significantly harder. You're forced to rely on less timely data. It really reduces shareholder protection.
In wrapping up management, the absolute deal breaker is the auditor's going concern opinion.
It cannot be overstated. This is the financial industry's equivalent of a formal emergency notice. The auditors are effectively stating that they lack confidence in management's ability to get the funding they need to keep the company operational over the next 12 months. When a public company gets this warning, the management's capital stewardship has officially been deemed a systemic failure.
So if management has run the company into the ground, let's look at the actual damage report. Chapter 3, Financial Health. The financial statements are the reality check that separates the dreamers from the builders. And they show a company that is actively struggling to cross the infamous valley of death. That period between deep R&D and sustained commercial scale.
Let's start with the income statement and let's focus on revenue. The company is, commercially speaking, pre-revenue. The sources are very explicit about this. SMX has not generated significant revenue from the sale of technology since its inception.
And yet the costs are substantial and they're accelerating, which suggests that their attempt to scale this molecular proof network is extremely expensive.
The burn rate is deep, and it's getting worse. The trailing 12-month net loss as of mid-2025 was a negative $44.04 million. That's a significant expansion from negative $31.09 million the year before. So this means that even with zero revenue, the company needs to find over $3 million every single month just to cover its costs.
And when you analyze those operating costs, you see a red flag that's really common, and companies focus more on stock promotion than on building a business. That's the ratio of general and administrative expenses, G&A versus research and development, R&D.
Right. In a deep tech startup that's truly focused on innovation, you would expect R&D to be the overwhelming expenditure. You're investing in the future.
Right.
However, in the first half of 2024, SMX reported G&A at $4.8 million, while R&D was only $1.6 million.
Wow. So what does that high G&A versus R&D tell us about what management is prioritizing?
High G&A signals that the company is spending way more on corporate overhead, legal fees, probably related to staying on Nasdaq and raising capital and administrative salaries, than they are on the actual core product, the engineering or testing that will drive future revenue. It suggests a huge overhead drag that's focused on staying listed rather than getting profitable.
Okay, let's move to the balance sheet, because this is where the crisis becomes immediate and just terrifying, the liquidity crisis. Given that $3+ million monthly burn rate, how much cash does this company actually have in the bank?
I want you to remember this number. As of Q3 2025, cash and equivalents stood at approximately $0.75 million. Wait, less than $1 million. In this kind of market, how does management even sleep at night knowing they have maybe 2 weeks of operational runway?
That is just
It's right.
utterly shocking for a Nasdaq listed company with a $31 stock price. $750,000 against a $3 million monthly burn. That provides zero room for error. This is the direct, brutal source of that going concern warning.
It forces management into a desperate cycle of capital raising. They have to constantly run back to the public markets, otherwise it's game over immediately. And compounding this, the debt situation is also challenging. They're carrying total debt of $7.73 million.
The real measure of their impending crisis, though, has to be the current ratio, which measures their ability to pay their short-term bills.
So we look at the working capital position. Current liabilities bills due within the year total $22.2 million. That massively outweighs their current assets, and this gives them a current ratio of a terrifying 0.08.
Okay, let's put that number into plain English for the listener. What does 0.08 actually mean?
A current ratio of 1.0 means you have exactly $1 of liquid assets for every dollar of bills due within the year. A ratio of 0.08 means that for every single dollar of bills coming due, the company has only 8 cents of liquid assets. This company is, by any standard financial measure, technically insolvent. They cannot meet their short-term obligations using their existing assets.
And the cash flow statement just confirms this total dependency. Free cash flow is negative, TTM negative $10.78 million.
The entire operational existence of SMX is dependent on cash flow from financing, that is, selling more stock and warrants. The $11 million lifeline they got in August 2025, which was part of $20 million in capital raises for the year, that wasn't an investment in growth. It was solely a transfer of capital from shareholders to the company's creditors and overhead. It was a temporary survival mechanism.
The financial verdict is brutal. An investor buying the stock today is basically acting as a lender of last resort. You're funding the company's electricity bills and corporate overhead, not buying a claim on existing sustainable profits. The only reason this company is still breathing is the promise of future equity raises.
And this analysis, based purely on the Graham framework, should dictate a price near zero. Yet the stock is at $31. So we must now turn our attention away from fundamentals entirely and focus on the mechanics and narratives that create this massive price dislocation.
Before we move into how the market perceives this company versus its brutal, near-insolvent financial reality, remember to show your support for this detailed analysis.
Like and subscribe to Stock Analytics AI.
For $4.99 month, get 500-plus deep dive videos on all S&P 500 stocks, with Nasdaq 100 coming next, plus members-only requested deep dives.
Okay, now let's pivot to the technical and speculative side of the equation, where reality bends to narrative.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership Risk, and Final Conclusion. Chapter 4, Market Sentiment. If the fundamentals are so terrifying, $0.75 million in cash, a 0.08 current ratio, we have to ask ourselves, how did the market ignore gravity? The answer lies in the technical structure and the power of a perfect narrative catalyst.
That 78.16% surge on November 28th was not random. It was the result of a very precise convergence of two high-momentum narratives: regulatory tailwinds favoring traceability and the company's aggressive strategic pivot into the tokenization space.
And the specific immediate driver was the company's successful positioning relative to the Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act.
This is a brilliant piece of speculative maneuvering. The Genius Act, or similar laws proposed in 2025, aims to create a clear, regulated framework for stablecoins. It defines what assets can safely back them. Think cash, treasuries, and potentially verified commodities.
So SMX is connecting its physical marking technology directly to this new regulatory push.
Precisely. They are trying to position their plastic cycle token, the PCT, and their gold tokens not as volatile, speculative cryptocurrencies, but as stablecoin-adjacent assets backed by verified, physically traceable commodities. That is the magic phrase that unlocks institutional dreams.
And the implication of that is massive. A token that's backed by a gram of SMX verified gold, provable by the molecular proof network, could theoretically qualify as a safe, regulated digital asset under this new framework.
And if that classification holds, it opens the floodgates to institutional capital. Banks, corporate treasuries, major ESG investment funds, who are currently prohibited from touching unregulated crypto, suddenly they have a pathway to invest in compliant, traceable, commodity-linked digital assets. SMX, as the verification layer, becomes indispensable. This is the blue sky scenario the market is pricing in.
And that narrative is just perfectly suited for the most volatile, high-risk segment of the market, what we call the retail swarm effect.
The gold plus crypto plus ESG compliance story is incredibly potent and so simple to market on social media platforms like StockTwits and Reddit. It combines FOMO with a perceived sense of societal good. The sentiment shifted almost instantly to extremely bullish following the news around the Dubai conference and the Genius Act alignment. This retail excitement provides the volatile fuel for the momentum traders.
And the data proves the stock is a playground for volatility. That adjusted 52-week range from $3.12 to over $66,000 at its peak. It just shows that fundamental reality is completely irrelevant here.
We have to emphasize that the 78% surge was not a calm, considered repricing by value investors. It was a violent reaction of momentum buyers hitting a structural roadblock, which brings us directly to ownership and market mechanics.
Chapter 5. Ownership Structure. The stock price isn't determined by the tiny cash balance. It's determined by the extreme scarcity of shares available for trading. We have to connect the devastating history of management dilution from Chapter 2 back to this immediate market surge.
The key mechanism here is the low float phenomenon, which is a direct consequence of those reverse splits. Every single time management consolidated shares to stay on the Nasdaq queue, they drastically shrank the number of shares actually available to the public for trading.
What's the critical number we're talking about after that last split in November?
Following the 1-for-8 split on November 18th, the publicly traded outstanding share count dropped to approximately 1.05 million shares. To put that in context, that is a microscopically small float for a Nasdaq Q-listed company. Major institutional investors often ignore anything below 5 million shares just because they can't get any liquidity.
So when algorithmic buyers or a swarm of retail traders come in, aiming to buy, say, 100,000 shares, that represents nearly 10% of the entire float. What happens then?
You get dramatic supply-demand dislocation, price violence. The positive news about the Genius Act triggers the buying. And that algorithmic or retail buying pressure hits a severe vacuum of supply. There are simply no sellers willing to part with their shares at the previous price. This is what allows the price to gap up by 40%, 60%, or 78% in a single day.
And we can probably assume that a short squeeze amplified this whole event.
Oh, highly probable. Short sellers who were making a fundamentally correct bet on the company's insolvency were likely trapped by the consecutive reverse splits and the shrinking float. They have a looming obligation to return the shares they borrowed. So when the price began its meteoric rise on the back of the Genius Act news, they were forced to cover to buy back the shares they shorted.
And trying to buy back those shares in a float of only 1 million becomes a frantic, impossible task.
Exactly. They are buying at any price just to avoid ruin. And that just compounds the buying pressure and drives the price up exponentially. The 78% surge is fundamentally a technical squeeze combined with the low float mechanics. It is not a sudden realization of intrinsic value.
We should probably revisit the insider ownership in this context as well.
Yes, founder Haggai Alon's 17.7% stake is significant. While he oversaw devastating dilution for many long-term retail holders, his personal wealth increases dramatically during these technical spikes. It really highlights the inherent misalignment. Management's priority is maintaining access to capital and increasing the nominal share price, which benefits their own equity value, even if it sacrifices the cumulative wealth of the defensive shareholder base.
So the stock is defined by technical volatility and narrative, far removed from the balance sheet. This brings us to the final assessment, the unquantifiable risks that make this stock simply too hard to analyze. Chapter 6, Risk Assessment. The Graham and Buffett framework instructs us to avoid businesses where the risks are so fundamental and unquantifiable that they destroy our ability to make a rational valuation. And SMX is just defined by a collection of binary, existential risks.
We'll have to start where Chapter 3 left off. The binary solvency and liquidity risk. This is the risk of permanent capital loss. The $0.75 million cash balance and the going concern warning are not abstract concepts. The primary risk is simple. If the market's exuberance stops, if the retail momentum fades, and the next equity raise fails, the company runs out of cash, cannot meet its $22 million in short-term liabilities, and the equity zeroes out.
This isn't a risk of the stock dropping from $31 to $25. It's the risk of the stock going to zero.
Exactly. It is an all-or-nothing bet on management's ability to secure emergency funding quarter after quarter.
And beyond the immediate cash crisis, the path to sustained commercial success is just fraught with adoption friction and execution risks.
Manufacturers are extremely cost-sensitive. The cost of embedding the SMX marker, training staff, installing proprietary readers, it's substantial. And manufacturers will only absorb this added cost if they can be assured of one of two things: either a guaranteed substantial green premium for their product or the avoidance of massive regulatory fines. Slow adoption just means the cash burn continues unchecked.
And there's also the gap between success in a lab and reality in a factory.
That's the execution hurdle. We see mentions of semi-industrial testing. This is fundamentally different from maintaining reliable performance in a high-speed, high-volume industrial environment. Like marching millions of tons of plastic flowing at 10 tons per hour in a dusty, high-vibration factory. Scaling the technology from a controlled pilot to guaranteed industrial resilience is where so many deep tech companies fail. And they often exhaust the remaining cash in the process.
Finally, let's explore the massive regulatory and geopolitical risk, especially with that ambitious tokenization play.
The Genius Act connection is high risk, high reward. The entire bullish narrative hinges on the hope that U.S. regulators, the SEC or the CFTC, will agree that the plastic cycle token and the gold tokens are stablecoin-adjacent commodities and not unregistered securities.
And if the regulators disagree, the legal risk is existential.
If the SEC classifies the PCT as an unregistered security, the company faces immediate existential legal threats, massive fines, and a complete torpedoing of their strategic pivot. Furthermore, their reliance on massive supply chain hubs like the Dubai Multi-Commodities Center exposes SMX to macro geopolitical risks. Trade wars, sanctions, tariffs. Any of those could instantly shut down key revenue streams before they ever materialize. This company is truly in the too hard pile for a defensive investor.
Okay. We've analyzed the business, the dysfunctional management, the catastrophic financials, the market drivers, and the existential risks. It is now time for the final verdict. Chapter 7. Conclusion. We have to bring all these conflicting factors together, the revolutionary technology versus the immediate solvency crisis. We need to apply the final Graham and Buffett scorecard to determine if this is a visionary opportunity or a speculative trap.
Let's summarize the assessment based on the 4 pillars of value investing. Business. Simple concept, high potential moat, but the economics are entirely unproven and require monopolistic adoption to justify the cost structure. Management. Highly promotional, relies excessively on destructive dilution, and has failed in responsible capital allocation, leading directly to these insolvency warnings. Financials. Failed. Severe cash burning, 75 cents cash reserves, 0.08 current ratio. Survival is dependent on continuous external financing. Valuation. Speculative. Completely, totally disconnected from current reality.
So the ultimate failure is just the inability to determine any kind of intrinsic value, which means we can't establish a defensive purchase price.
Right. A standard discounted cash flow, or DCF model, which is the gold standard of valuation, fails instantly. You cannot discount positive cash flows if none exist, and the company is burning tens of millions of dollars a year. Any high valuation relies entirely on speculating about a distant, highly unlikely terminal value where SMX has somehow achieved monopoly market status. And that's not analysis, it's pure speculation.
To ground this discussion in reality, we have to use a relative comparison. Let's compare the price of SMX's dreams to the proven reality of a competitor like Digimarc.
The contrast is shocking. Digimarc has an established cash-generating business, a market cap of around $150 million, and trailing 12-month revenue of about $33.6 million. This places their price-to-sales ratio in a reasonable, if ambitious, range of 4.5 to 8.0.
Okay, now look at SMX. It has an estimated market cap of $32.55 million at its $31 price, but its recognized sustained revenue is negligible, estimated at less than $1 million.
This means that on a conservative price-to-sales basis, SMX is trading at over 32 times estimated minimal revenue. It is priced not for future growth, but for absolute guaranteed market dominance. The price assumes that every single partnership, DMCC, TradePro, Continental, succeeds flawlessly, and that the company suddenly achieves profitability next year despite the current cash crisis.
Let's define the 3 probability-weighted outcomes for the listener.
Okay, scenario A, the win. The Dubai Ingenious Act strategies pay off. SMX becomes the mandated standard, achieving a massive toll bridge. Cash flow turns positive, management stops the dilution, and the valuation soars past $200 million. Given the financial fragility, we assign this a maximum 10% probability.
Scenario B, the dilution grind. The pilots continue, but scaling is slow and expensive. The cash burn forces management to execute continuous, deeply dilutive equity raises every 3 to 6 months. This wipes out existing shareholders by 50% or more over the next 2 years. The stock price drifts back down to reflect the solvency risk, settling in the $5 to $10 range. This is the most realistic outcome at 50% probability.
And scenario C, insolvency. Funding dries up. The market loses appetite for microcaps or the regulatory risk materializes. The going concern is realized and the company files for bankruptcy. Given the 0.08 current ratio, we have to assign this a significant 40% probability.
So the expected value calculation is just heavily skewed to the downside. The $31 price is an artificial construct of market mechanics.
Our final verdict is avoid sell. The stock price is a temporary liquidity spectacle, completely disconnected from financial reality. Based on a conservative shell or liquidation value, accounting for the debt and liabilities, we estimate the intrinsic value to be less than $5 per share. The stock is currently trading at a premium of approximately 520% to that defensive estimate. You have zero margin of safety.
It sounds like an incredible technology trapped inside an incredibly fragile, high-risk operational structure.
And what this teaches you, the listener, is the vital difference between a truly fascinating technology indicator and a viable investment. The technology behind SMX is worth observing closely because its success or failure signals the viability of the entire circular economy model. But the equity is not worth owning today. The prudent path is to watch SMX purely as a technology indicator. If they manage to navigate the next 12 months without wiping out shareholders via more massive dilution, and if real, sustainable material revenue starts flowing from the Dubai and TradePro partnerships, measurable, reliable revenue, only then should a defensive investor revisit the case. Until then, you must stay clear.
We hope this deep dive gave you the clarity you needed to understand the extreme divergence between price and true value in the case of SMX.
Like and subscribe to Stock Analytics AI.
This research is generated based on public information and sources shared with us. It is not financial advice, and you must conduct your own due diligence before making any investment decisions. Thank you for joining the deep dive.